Welcome back to Investing Talk Podcast.
It's great to be back, and today we are diving into a story that sits right at the intersection of wild market speculation and, frankly, serious national security.
We really are. We're talking about a stock that is up nearly 230% in the last year. I mean, that alone is incredible.
And that's not even the whole story.
No. If you think that's crazy, it's up over 30% just in the last month. That's just January 2026. The chart looks less like a stock ticker and more like a rocket launch.
It really does, but, looking at the chart is just the surface. Understanding why it's moving like that is where the real analysis comes in.
Exactly.
We aren't just looking at another mining company digging holes in the ground hoping to strike gold. We are looking at MP Materials. And the reason this matters, the so what here, is that MP is the only scaled rare earth mine and processing facility in the entire Western Hemisphere.
Which, given the geopolitical climate right now, sounds like an incredibly valuable position to be in.
Valuable is an understatement. This company has effectively become the cornerstone of the United States strategy to break China's grip on the critical supply chain.
And when we say critical, we're talking about
the magnets that go into electric vehicles, wind turbines, and yes, F-35 fighter jets. If you care about the future of tech or national security, you have to care about this stock. Today, we're looking at MP Materials.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us get this data out to more investors like you. Now, let's unpack this. Because when I look at the headline numbers for their recent quarter Q3 2025, it's a bit of a mixed bag if you don't have the context.
Right. If you just scan the surface, you might get spooked.
Exactly. I'm looking at the sheet here. They reported revenue of $53.55 million.
Yeah.
Now, for a company with this much hype, that might seem low, but the kicker is that it's actually down 14.9% year over year. Usually when I see a growth stock with revenue dropping double digits, I start looking for the exit door.
And that is exactly why this story is so interesting. That revenue drop, it was intentional. It wasn't because demand dried up or they couldn't sell their product. It was a strategic choice.
Strategic in what way?
Well, think about their old business model. Historically, MP would mine the rare earth concentrate, basically, the raw dirt, and ship it to China for processing.
That's where all the revenue came from.
Exactly. But recently, they stopped selling that concentrate to China. Instead, they're holding on to that feedstock to process it domestically as their new facilities ramp up. They're trading short-term revenue for long-term vertical integration.
So just so I understand, they're taking a hit on the top line now, keeping the raw material in-house so they can own the whole value chain later.
That's it. Imagine a baker who stops selling flour to the competition because they're building a massive industrial oven to sell finished bread at a much higher margin.
You lose the flour sales today, but you win the bread market tomorrow.
Precisely. And despite that revenue dip, they still beat on the bottom line. Adjusted earnings per share came in at negative 10 cents.
Which, on paper, sounds bad. Nobody likes negative earnings.
It sounds bad, but Wall Street was expecting negative 15 cents. So they're losing less money than the smart money thought they would. They're managing their cash burn incredibly well.
Okay, so they're pivoting the business model and managing expenses. But an earnings beat isn't why the stock is up 30% this month. The real catalyst, the thing we need to spend some time on, is the bazooka news that dropped in mid-January.
The Department of Defense deal.
Right. And calling it a deal almost undersells it.
It really does. The Pentagon isn't just a customer anymore. As of mid-January, the Department of Defense is effectively the largest shareholder in MP Materials through a massive $400 million equity investment.
That is just wild. You don't often see the U.S. government buying equity stakes in publicly traded companies like that.
Yeah.
It feels more like a defense contractor relationship, like a Lockheed or a Raytheon, than a standard mining play.
It's a total paradigm shift. And it gets better for the bulls. The DoD didn't just buy stock. They signed a 10-year offtake agreement. But the most critical detail, the one that I think justifies the premium on this stock, is the price floor. They have a guaranteed floor of $110 per kilogram for NdPr oxide.
Let's pause on that for a second because that is huge. I want to make sure everyone listening gets the gravity of that. In mining, your biggest risk is always the commodity cycle.
Always.
You spend billions building a mine, and then the price of the metal crashes because of a supply glut, and suddenly you're bankrupt. We saw it with lithium in 2023. We saw it with nickel.
It happens constantly. It's the boom and bust cycle that just kills these companies.
But here, the U.S. government has essentially removed that risk. They've said, We will pay you at least 110 a kilo no matter what the market does.
Yeah.
It's like having an insurance policy paid for by the taxpayer.
It effectively creates a safety net under their revenue model.
Hmm.
Even if the global market floods with cheap supply from overseas, MP remains profitable on that contract. It de-risks the investment significantly.
And on top of the equity and the offtake, there's even more liquidity.
Oh, yeah. They got a $150 million loan from the DoD and a massive $1 billion financing commitment from JP Morgan and Goldman Sachs for their new 10X facility.
That $1 billion commitment is interesting because it shows Wall Street is lining up right behind the Pentagon.
Yeah.
It's not just government money. Private capital is flooding in, too.
It's a validation of the technology in the business plan. Banks don't lend $1 billion on a whim.
And speaking of private capital and validation, we can't forget the commercial side. It's not just tanks and missiles.
No, it's consumer tech, too.
The Apple partnership.
Exactly. That's a $500 million multi-year deal, and Apple gave them a $200 million prepayment. That is cash up front to secure supply.
And Apple doesn't do that lightly.
No, they do not do that unless they are genuinely worried about supply security. They need these magnets for the Taptic engine in the iPhone, for the magnets in iPad cases, for their EVs.
And then they have the Saudi joint venture with Maiden for the heavy rare earths, looking out to 2028. So you have the U.S. Defense Department, Apple, and Saudi Arabia all effectively backing this one horse.
It's a powerful trifecta. You've got national security backing, consumer tech volume, and a sovereign wealth fund timeline.
Let's look at the balance sheet, though, because all this expansion costs money. I'm looking at the safety numbers here. They have a quick ratio of 7.51 and a current ratio of 8.05.
For those listening who aren't accountants, break that down. Why do those numbers matter?
Sure. So the current ratio basically measures if you can pay your short-term bills with your short-term assets. Anything over 2 is usually considered very safe. 8. That is essentially a fortress of cash. They could pay their bills 8 times over without breaking a sweat.
They're flush with liquidity, and their debt to equity is only 0.47. They aren't over-leveraged, which is rare for a company in such an intense build-out phase.
It is. Usually miners are drowning in debt at this stage. The only ugly mark is the margins. Net margin is currently negative 50.55%. They're burning cash to build these factories.
They are, but management has guided for a return to profitability in Q4 2025, which is basically now, given the timing, as the Texas facility ramps up. So we are right at that inflection point where the cash burn should flip to cash flow.
Okay, that's the fundamental landscape. A government-backed monopoly with a fortress balance sheet, just waiting for the profits to turn on. Now let's pivot to the charts, because the technicals are telling their own story.
Oh, the technicals are screaming momentum!
We mentioned the price is trading around $69.30 as of mid-January, but it's the trajectory that's fascinating. It's just been a straight line up.
It's a rocket ship trajectory. We recently hit intraday highs near $70.92. The stock just smashed through previous resistance at 66 like it wasn't even there.
Yeah.
When a stock breaks a major resistance level on this kind of news, it often becomes a new floor.
And looking at the moving averages, the 50-day is way down at 57.48. The stock is trading significantly above its average price. On one hand, that shows incredible strength. On the other hand, as a skeptic, I worry about it being overextended. It's moved very far, very fast. That rubber band is stretched tight.
That is a valid concern. You often see pullbacks after a run this violent, but look at the volume. That tells you who's buying.
Yeah, the volume spikes are telling. On January 21st, volume was 39% above average. That isn't just retail traders buying a few shares on an app.
No.
That is institutional money. That is mutual funds and pension funds loading the boat.
Exactly. The structure of the chart shows higher highs and higher lows. It's not just a pump where it goes up and crashes. It goes up, consolidates sideways, and then goes up again. That signals sustained accumulation. The big players are building positions.
So the price action backs up the fundamental story. The market believes the hype. Which brings us to what the smart money is actually thinking. Let's look at the sentiment.
The sentiment right now is overwhelmingly positive.
I pulled the quantitative score from our data provider. The sentiment score is strongly bullish. It's coming in at a weighted score of about 0.42. For context, anything above 0.15 is considered bullish.
That's a huge number.
It is. We checked the last 9 major news items, and 6 of them were positive. It's just hit after hit of good news.
And Wall Street is chasing it. You track the analyst upgrades. What are they saying?
They are loving it. William Blair recently initiated coverage with an perform rating, and an $80 price target.
$80. That's still, what, another 14% upside from here?
Roughly, yes. And that's the consensus. Most targets are sitting in that $78 to $80 range. Barron's even maintained a perfect buy rating on the stock.
So the narrative on the street is that this is a must-own asset.
It is a must-own for the energy transition and defense. However, and you knew there was a however coming,
I was waiting for it. The other shoe drops.
I found a divergence that we need to talk about. It's a bit of a yellow flag, maybe even a red one. Well, Wall Street is screaming buy.
Right.
The people running the company are selling.
The insider sales.
Yes. The CEO, James Litinsky, and the CFO sold roughly $62.8 million worth of stock recently. Now, I know executives sell for all sorts of reasons, but $62 million is a lot of chips to take off the table right when your stock is supposedly about to go to the moon.
It is a significant amount. I grant you that. It definitely raises an eyebrow.
Right. If I knew my company was about to become the most important miner in the world, I'd be holding every single share.
Well, we have to weigh that against who is buying. You mentioned the institutions earlier. The New York State Teachers Retirement System increased their stake by almost 12% in Q3. Institutional ownership remains very high, over 52%.
So the teachers and the pension funds are buying while the CEO is selling. That's the divergence.
It is. But remember, the CEO still holds a massive amount of equity. If the ship goes down, he still loses a fortune. But the institutional confidence, the fact that big money is increasing stakes, tells me they aren't worried about the insider sales signaling atop.
Fair point. It's not necessarily a fire alarm, but it's worth watching. But let's take off the rose-colored glasses for a minute. We've talked about the DoD bazooka, the Apple deal, the breakout chart. But what could go wrong? Let's look at the bear case.
Let's do it. The risks are real, and we need to face them.
The first one staring me in the face is valuation vertigo. This stock is expensive.
It's definitely not a value play in the traditional sense. You aren't buying this for the dividend.
The price-to-sales ratio is somewhere between 22 and 48 times, depending on the metric you use. The industry average for mining is closer to 1.4.
That is a massive premium. That is a tech valuation, not a mining valuation.
Exactly. It is priced for perfection. When you are trading at 40 times sales, you cannot afford a single mistake. If they miss an earnings call or if there's a delay, this stock doesn't just dip, it crashes. A 30 to 40% drawdown is entirely possible if the narrative cracks.
And that ties right into the execution risk. The strategy here is mine to magnet. It sounds great on a slide deck, but it is incredibly hard to pull off.
Can you explain that a bit more? Why is it so hard?
Well, mining is just moving dirt. But separating rare earths, that is complex chemical engineering. You have to separate elements that are chemically almost identical. And then turning that oxide into a metal and then into a sintered magnet, that is high-precision manufacturing.
And they have to do this at scale.
Right. They have to finish the Texas Independence facility, which is commissioning this year, 2026. Then they have to build the 10X facility by 2028. And they aren't just making generic magnets. They are manufacturing for Apple.
And Apple is notorious for having the strictest quality thresholds in the world.
Exactly. If MP sends a batch of magnets that are slightly off spec, maybe the magnetic field isn't uniform, Apple won't just say, do better next time. They could pull the contract.
That is a very real operational risk. Scaling manufacturing is much harder than scaling mining. Construction delays, cost overruns, these are all things that could derail that perfect timeline the stock price is assuming.
And finally, there is the political dependency. The entire thesis rests on the idea that the U.S. government will keep throwing money at this to stop China.
Right. The China fear trade.
But political winds change. If geopolitical tensions cool down, which granted doesn't look likely, or if a new administration decides they don't want to subsidize mining anymore, that urgency and funding could dry up. This company is on life support from the DoD right now.
If that cord gets pulled, the valuation collapses.
It does.
That is true. Though I would argue that supply chain independence is one of the few bipartisan issues left in Washington. Whether it's Republicans or Democrats, nobody wants to rely on China for fighter jet components. But you are right, it is a risk. We're betting on government policies staying consistent.
Which is always a gamble. So we have a sky-high valuation, massive execution hurdles, and political reliance. But we also have a government guarantee, huge growth potential, and a breakout chart. It's time for the verdict.
It is time to score it. Considering everything, the fundamentals, the technicals, the sentiment, and the risks, what is your bullish score for MP Materials?
I'm giving this an 8.5 out of 10.
8.5. That is very high for you. Break down the thesis.
Look, here's the elevator pitch. MP Materials is effectively a government-backed monopoly on U.S. soil. The DoD price floor of $110 a kilogram puts a safety net under the revenue that almost no other company in the world has.
So you have downside protection.
Downside protection from the Pentagon, and you have explosive upside from the mine-to-magnet integration. It's the floor plus the growth.
And the time horizon.
My target horizon here is a multi-year hold. You don't buy this for a trade next week. The real payoff is 2026 to 2028. That's when the magnet facilities come online, that's when the margins flip from negative to positive, and that's when this company transforms from a miner into a tech industrial giant.
I have to agree with the national security play angle.
Sure.
It's rare to find a stock where the government essentially says, we cannot let this fail. But I will add my usual warning, size your positions carefully.
Absolutely.
Do not bet the farm on a company trading at 40 times sales, no matter who their partners are. If you're going in, expect volatility, expect 20% swings. But if the thesis holds, the direction is up.
And that's the key. If you can stomach the volatility, the destination looks very promising.
Well, that's a wrap on MP Materials. A fascinating look at how geopolitics is reshaping the stock market.
It really is the ultimate intersection of policy and profit.
As always, thank you for tuning in. Make sure you subscribe to the channel for more of these data-driven breakdowns. We'll be back soon with another deep dive.
See you next time.